The stock market made a lot of people rich last year. It also made a lot of beginners lose money they couldn't afford to lose, not because the market was wrong, but because they started without understanding the most basic rules of how this game actually works. Here's the reality in 2026. The information about investing has never been more accessible. There are more platforms, more tools, more resources than at any point in history. And somehow, despite all of that access, the average retail investor still significantly underperforms the market they're invested in. Not because the market is rigged, not because they chose bad stocks, because they never understood the foundational principles that determine whether you build wealth through the stock market or whether the stock market becomes an expensive lesson in what not to do. Today, we're going to fix that. By the end of this video, you will have a complete, honest, beginner's framework for stock market investing in 2026, what actually works, why most beginner strategies fail, and exactly how to position yourself to build real wealth over the next 10, 20, 30 years. Not tips, not tricks, the actual foundation. Let's get into it. My name's Alex, and I study the gap between how people think investing works and how it actually works. That gap is enormous, and it's expensive. The good news is that once you understand how the stock market actually functions and what your job as an investor actually is, the whole thing becomes far simpler than financial media wants you to believe. Let's start at the beginning. Here's the first thing most beginners get wrong, and it costs them everything downstream. They think the stock market is a place where you predict which companies will go up and buy those, and avoid the ones that will go down. That's trading. It is not investing, and the distinction matters more than almost anything else you'll learn today. The stock market is not a game of prediction. It is an ownership mechanism. When you buy a share of stock, you are buying a small ownership stake in a real business. That business has employees, customers, revenue, expenses, assets. You now own a piece of that. Over time, as businesses grow, as they serve more customers, generate more profit, reinvest in their own expansion, the value of your ownership stake grows with them. This is not gambling on price movements. This is owning a piece of the most productive engine in human economic history, the publicly traded business. The S&P 500, an index of the 500 largest American companies, has returned an average of approximately 10% per year before inflation over the last century. Not every year, not in a straight line, but over time, consistently, relentlessly upward. That's not luck. That's the compounding of human economic productivity. And your job as an investor is not to predict the market, it's to own it and to have the discipline to keep owning it when it gets uncomfortable. Before we talk about what to do, let me show you what beginners actually do and why it destroys their returns. Mistake 1. They try to pick stocks they think will outperform. Here's the brutal reality. Over any 15-year period, more than 90% of actively managed funds run by professional analysts with teams of researchers and billions in resources underperformed the simple index fund that just owns the whole market. If professionals with every advantage available can't consistently beat the market, the idea that a beginner scrolling through Reddit forums or watching YouTube videos is going to find the next 10x stock is statistically unlikely to the point of being not worth the attempt. Mistake 2, they try to time the market. I'll wait for the dip, I'll get back in when things settle down. This strategy sounds rational. The data shows it is devastating. Research from J.P. Morgan shows that if you missed just the 10 best trading days in the stock market over the past 20 years, your overall return was cut in half. The problem, those 10 best days typically occur immediately after the worst drops, which is exactly when nervous investors have already pulled their money out. Mistake 3, they react to headlines. Every year there's a crisis, a recession fear, a geopolitical event, a Federal Reserve announcement, a crash, a recovery.
Each one produces a wave of commentary designed to make you act. The investors who acted, selling during the 2008 crash, pulling out during COVID and 2020, panicking during the 2022 rate hike sell-off, locked in losses and missed some of the largest recovery rallies in history. The investors who did nothing, who held their positions and kept contributing, recovered and surpassed their previous highs every single time. The market rewards patience. It punishes reaction. So if stock picking doesn't work, timing doesn't work, and reacting to headlines doesn't work, what does? 3 things. 3 simple, boring, historically validated things. Own the whole market through low-cost index funds, contribute consistently over time through any market condition, and give your money enough time to compound. That's it. That is the framework that has built more long-term wealth for more ordinary people than any other approach in the history of retail investing. Let's go through each piece. Own the whole market through low-cost index funds. An index fund is a fund that tracks a market index, like the S&P 500. It doesn't try to pick winners. It simply owns a proportional slice of every company in the index. When Apple does well, you benefit. When a smaller company you've never heard of has a breakout year, you benefit. When the overall market grows, you grow with it. The fees on index funds are minimal. We're talking 0.03% to 0.15% expense ratios for the best ones. Compare that to an actively managed fund charging 1% or more annually and underperforming the index despite it. For 2026, the core building blocks for most beginner portfolios remain the same as they have been for decades: a U.S. total market index fund, an international index fund, and, depending on your timeline, a bond index fund for stability. 3 funds, thousands of companies, maximum diversification, minimum cost. There is no combination of individual stock picks that reliably beats this over 30 years for a regular investor. The research is unambiguous. Component 2, contribute consistently regardless of what the market is doing. This strategy is called dollar-cost averaging, and it is one of the most psychologically important tools available to a beginner investor. Here's how it works. You invest a fixed amount, say $300 a month, on the same date every month, no matter what the market is doing. When prices are high, your $300 buys fewer shares. When prices are low, your $300 buys more shares. Over time, you automatically accumulate more shares when the market is cheap, which is exactly when you should be buying, and fewer when it's expensive. More importantly, it removes the psychological burden of trying to pick the right moment. You're not timing anything. The timing is built into the system. Let me show you what consistent contributions actually produce. $300 a month invested from age 25 at 8% annual returns becomes approximately $1,050,000 by age 65. 40 years, $300 a month, $1 million. Of that million, roughly $144,000 is money you actually put in. The remaining $906,000 is compound growth, money generated by time and consistency, not talent. That is the power you're building when you automate a monthly investment and then leave it alone. Psychological insight. Here's where I want to spend a minute on something that's more important than any strategy. The single greatest threat to your investment returns in 2026 is not inflation, not interest rates, not market volatility. It's you. More specifically, it's the psychological response to market volatility that causes investors to make decisions they later regret. When the market drops 20%, and it will drop, your brain does not read that as an opportunity to buy more shares at a discount. It reads it as danger. It registers loss. It generates fear, and fear makes you want to do something. That something almost always costs you money. The research from behavioral economists like Daniel Kahneman shows that losses feel approximately twice as painful as equivalent gains feel good. So a 20% drop feels roughly twice as bad as a 20% gain feels good. Your brain is wired to feel market drops as emergencies, even when your rational mind knows they're temporary. The framework for surviving this, and it requires a real framework, not just be patient, is to decide in advance how you'll behave during a crash. Write it down. When the market drops 20%, I will not sell. I will continue my automatic contributions. Make the decision before the fear exists, because in the middle of the fear, you will not make good decisions. The best investors are not the ones who feel the least fear. They're the ones who built a system that doesn't require them to make emotional decisions under pressure. Give it enough time and understand what enough time actually means. Here is one of the most misunderstood aspects of stock
Market investing. The short term is genuinely unpredictable. In any given year, the stock market might be up 30% or down 30%. Nobody consistently knows which it will be, and anyone who claims otherwise is selling something. But the long term is remarkably reliable. Over every 20-year period in S&P 500 history, the index has produced positive returns, even accounting for major crashes, recessions, wars, pandemics, and crises of every type. This means the risk in stock market investing is almost entirely concentrated in the short term. If you might need the money in the next 2 to 3 years, it should not be in the stock market. If it's money you won't need for 10, 20, 30 years, historical data says the risk of a poor long-term outcome approaches near zero. The practical implication? Don't invest money you might need soon. Build your emergency fund first. Then invest only with a genuinely long time horizon. The investors who got hurt worst in every market crash were those who were forced to sell because they had invested money they needed in the short term. The investors who came out ahead were those who had no reason to sell. Your time horizon is your most powerful risk management tool. Let me briefly address the specific environment you're starting in. In 2026, interest rates have normalized from their post-pandemic peaks. The market has recovered significantly from the 2022 correction. AI-driven productivity gains have created genuine value across multiple sectors. International markets offer compelling valuations relative to U.S. equity prices. What does all of this mean for a beginner investor starting now? Honestly, much less than financial media wants you to believe. The macro environment changes every year. The principles don't. Starting today is better than starting tomorrow. Starting with $100 is better than waiting until you have $1,000. A simple index fund today beats a better strategy that you start 6 months from now. The one 2026 specific consideration worth acknowledging is that with more market intelligence available through AI tools, algorithm-driven trading, and sophisticated institutional participation, the market is more efficient than it has ever been, which means the case for passive index investing over active stock picking is stronger in 2026 than it has ever been. The smart money is index funds. It has always been index funds for most people. In 2026, that conclusion is even more firmly supported by the evidence. So here's how you actually start in 2026. Step 1. Open a tax-advantaged account. A Roth IRA, if you have earned income and meet the income requirements. Your money grows tax-free, and withdrawals in retirement are tax-free. Or a 401k through your employer, especially if they offer a match. Start there. The tax advantages compound just like returns do. Step 2. Fund it with whatever amount you can start with consistently. $50, $100, $300. The number matters less than the habit of consistency.
Set up an automatic transfer on payday so the decision is removed entirely. Step 3. Invest in a total market index fund. In a Fidelity account, that's F0ROX or FSKAX. In a Vanguard account, that's VTI or VTSAX. In a Schwab account, SWTSX. The specific ticker matters less than the principal, total market, low cost, diversified. Step 5. Add an international fund for geographic diversification. 20 to 30% of your equity allocation in international equities is a sound starting point for a long-term portfolio. Step 5. Don't touch it. Review once a year. Rebalance if one allocation has drifted significantly. Otherwise, let time work. 5 steps. No financial advisor required. No market expertise required. No trading skill required. Just the discipline to start, the consistency to continue, and the patience to let the math do what the math does. Here's what I want you to carry with you. The stock market is not a casino. It's not a get-rich-quick machine. It's not a place for predictions or hot tips or seasonal patterns. It is the most powerful long-term wealth-building mechanism available to a regular person when used correctly. Using it correctly doesn't require intelligence above average. It doesn't require hours of research. It doesn't require understanding macroeconomics or reading earnings reports. It requires owning the market broadly, contributing consistently, and having the discipline not to undermine your own results with emotional decisions during temporary downturns. The people who have built real wealth through the stock market are not the ones who found the best stock picker or the best timing signal or the most exciting strategy. They're the ones who started early, kept going when it got uncomfortable, and trusted a simple system long enough for decades of compounding to do its work. The market will test you. It will drop. Headlines will scream. Friends will panic. And every time that happens, the right answer is the same answer it's always been. Own it, hold it, add to it, trust the math. The people who do that quietly, consistently, without drama, are the ones who retire with more than they ever thought possible from a life that never felt like it paid enough. Start today. The market is waiting.